Welcome to our audience from around the world to this special digital edition of the 2026 Avanti Report. Thank you for spending some time with us today. My name is Ricardo Terán. I'm the Director of Business Development at Avanti Way and co-founder of Folio Title. I'm honored to be your host today. We want to give a shout out to all of the real estate agents and professionals who are gathered today at watch parties and offices to learn about the state of real estate in Florida and the United States. Feel free to capture and share screenshots and videos of where you're watching and update them to your social media channels by tagging @AvantiWay and hashtag Avanti Report. If you're not already following us, hit that subscribe button. So what is the Avanti Report? The Avanti Report is South Florida's premier real estate event where agents, brokers, mortgage and title professionals, and investors come to understand what's really happening in the residential and commercial markets, and more importantly, what's coming next. For the past 7 years, we've brought together some of the most respected voices in the industry, along with thousands of professionals, all focused on one thing: turning real data into smarter decisions and winning strategies. Because in today's market, with so much uncertainty and rapid change, guessing is expensive. The professionals who win are the ones who understand the data and act on it. That's exactly what the Avanti Report is built for. And today marks something new for us, a special digital edition of the Avanti Report. Over the next 90 minutes, we're going to break down what actually happened in the last 12 to 15 months, and most importantly, what it means for where the market is headed next. If you're trying to make sense of the shifting prices, inventory, and buyer behavior, today's report is going to give you the clarity and context to better advise your clients and help them make smarter decisions moving forward. So I highly encourage you to stay with us through the full presentation and listen to our amazing guests, which I'll introduce in a second. But this is just a preview of what we're going to do at a much bigger level, because the full Avanti Report experience is happening live in October 27th in Coral Gables. And if you're serious about staying ahead in this market, you're really going to want to be there. We'll be releasing new data, new insights, and bringing together top experts to break down exactly where the Florida market is headed to next. You can sign up now at avantireport.com or using the QR code on your screen. We're also going to paste a direct link in our live chat, so make sure to click and secure your spot early because space is limited and you don't want to miss this event. Before we get into today's insights, I want to take a moment to recognize the partners and sponsors who make all of this possible. An event of this scale and the data you're about to see wouldn't happen without the support of our incredible sponsors. So I want to give thanks to Pillar to Post Home Inspections, The Standard Residences in Brickell, Miami, Avanti Way Capital, Christopher Sierra CPA, The Marketing Verse, Propfolio, Avanti Way Financial, and Folio Title. We'll be talking a little bit more about our sponsors later. Now, it is my honor to introduce today's expert panel. First, Enrique Terán, the Avanti Way Group co-founder and CEO, and one of the founders of the Avanti Report, and Andres Corda, the other co-founder of the Avanti Way Group and CEO and founder of the Avanti Report. Gentlemen, it is a great pleasure to have you here with us today.
It's a pleasure to be here. Thank you.
We're going to have a great conversation here today with these two experts, and we're going to start with Enrique to give us an update on his keynote presentation that he's been doing for a couple of years called The State of the Market. This State of the Market gets updated every year with the latest information to make decisions. So I'm going to hand it over to Enrique to talk to us a little bit about where is the value of real estate going.
Perfect. Thank you so much, Ricky. And it's always an honor to be here at the Avanti Report, sharing with our community of agents and giving them the insight they need to make smart decisions out in the market. So, where is the value of real estate going? Last year, we took the strategy of talking about rates, rents, income, and prices, because I do feel that these are the factors that are holding up the market today, and we're going to see some key pivotings here that would cause the market to fluctuate in terms of pricing, right? So let's get started with demand, right? What are we seeing with demand? Interest rate is a key factor of demand. We saw them go down in the last 6 months, I would say, and obviously we saw demand increase. Now, if you look at this chart, the current difference is about 2.04% from the 10-year Treasury versus what the 30-year fixed rate is funding at. That typically, historically, has been between 1.5 and 1.8. So there's still a bit of a difference there, and this is caused right now by the war. The war is actually affecting rates as oil prices increase, and ultimately the market is spreading that into that rate.
And
right?
traditionally, mortgage rates have been more correlated with a 10-year treasury than, for example, the Fed funds rate or another rate.
That is correct, 100%. So we still will see some compression as the war settles, and obviously there's more predictability in the uncertainty that we have in the markets right now, right? The Fed is saying that they will not increase or decrease rates. So we're probably going to stay at the same Fed rate that's there. Now, the Fed rate does not naturally translate to interest rates or mortgage interest rates you're getting in your house, right? Although there is an effect, it's not a direct effect. Now, what's been very interesting, if we look at this chart here, from January 2025, the average interest rate was 7.6%, and for a $500,000 home, your principal and interest was $3,414. In April 6, 2026, rates were 6.45. At $500,000 home, you are now paying $270 less per month. That is actually a pretty big change. That's almost I want to say 8%, 9% drop in what the monthly payment would be. And rates actually got to 5.99%. Not too long ago, that's $419 that people save a month. That is a really, really good sign for the affordability crisis that we're in. Now, moving over here, I want to bring this slide up for Avanti Way Financial because we were tracking rates at that same time, and we were funding at that same time, where you notice that by April 6, Avanti Way Financial was funding at 5.25, and right now it's at 5.5 because obviously rates went up. So there is a huge difference between what we're seeing in the regular market plus what we're seeing with our partners at Avanti Way Financial. There's huge savings into what consumers are beginning to see out there.
I think that's a testament as well to the importance of local experts who truly understand the
Right.
kind of inventories that are present in the market and what this market really can hold, because basically Avanti Way Financial is beating the national averages by a lot.
By a lot. And it's carving away more affordability, right? When you're saving 19% on your monthly payment, that's a big, big chunk of cash for the consumer, if you will. So the next slide is obviously we're seeing the volatility. In the last several months, you'll see a huge spike here in this graph, right? Where interest rates went up. Again, this is due to the Iran war, and we have to see how this ends up, right? If control is not given for the straits or reopen, then we're gonna have an issue where oil prices will continue to rise. If it does open, it'll settle and move forward. And we'll have to keep our eyes on that strategy. Now, we're looking at buyer activity across the United States. We're always tracking these numbers. And I thought this was interesting because in the last quarter, we've seen the highest uptick of buyer activity within the markets, right? They're applying for more mortgages, they're going out, there's more pending sales. So we're starting to see that they're picking up in the correlation that we've always talked about. Interest rates do correlate with demand. And here's a graph that I've been showing for many years that we've been tracking. The red shows the weak demand when interest rates are above the 6.5 marker. Yellow would be limited demand, and then we'll go into moderate and strong demand. We are right now, currently this month, in a market of limited demand because rates went up. But they're projected to go back down over time.
What's very interesting is that in last year's Avanti report, this graph, when we cut it off about a year ago, the projection was that we would see increased demand and that the interest rate would continue to come down, which is what happened. This sudden spike has been this externality, this external factor that is obviously impossible to predict, but we were headed well on our way into the green territory there with moderate demand.
Yeah, and what's been interesting is that the momentum we picked up before that spike is what we're feeling right now. We're feeling the surge and momentum moving, but rates went back up, which can slow us down a little bit.
I think as far as rates, another thing that's been moving the needle is the fact that the rates shock is already over. That's already past news. I mean, we've had that rate spike since, we were used to 0%, rates and very low rates, and then that whole spike, and then the post-COVID era already kind of leveled to a new normal, no? And,
right.
and so people now are, you know, when you see uncertainties where people just stay out in the sidelines, when you see, okay, this is the new rate environment, I need to make my decisions based on this, and I'm going to plan accordingly, you know? And,
the good news is obviously we saw rate compression before that was reaching into the 4.99% for FHA loans, 5.2, 5.3 on conventional loans, right? So we're getting into that green territory, and we're fighting between the green and the yellow in the market, no? In terms of the United States, if we look at the entire market, you'll see the ups and downs here of how many sales there are on an annual basis. And we've plateaued since basically COVID. We got out of COVID, post-COVID. We've been going up and down, and we've stayed pretty much hovering around the same level. Now, the interesting part, though, if you look at the detail of this graph, is that there is more blue than gray, right, at the end part of it, showing that demand is picking up a little bit, but it's stable, it's plateaued. There's slight increases that we begin to feel. Now, I want to bring something to light here. When you take the per population effect of how sales are going right now, it is the least ever recorded in history by population. In 2008, when the crisis hit, we had little sales, like you'll see here, and they were only for a blip of a second, right? But the population was much less. So the impact right now, obviously, of the markets are not moving the way they normally have moved. Now, the interesting part is how have prices held up against that? Because the natural theory is prices should come down if demand is so low, right?
that's what we're calling today Rent America, right?
Right,
You know,
there you go.
you have people renting, so the price of rent is also very important to this scenario, and why sales are so low. It's that combination of things that you're seeing now.
And here I draw the comparison of the United States, right? And then we'll jump into Florida. And you'll see Florida's line is basically hovering at about 2014 in terms of sales. It's not as bad as the entire United States. We're outperforming that market.
So Andres is going to talk to us later today about the migration effect into Florida. So even with the growth that Florida has seen in terms of its population, we're just hitting 2014 levels for closed sales.
For close sales.
But it's crazy because in any other world, when you look at demand-supply effects and prices, prices should be plummeting. If you're at the lowest level per population, in any other scenario, prices should be going down. So it's interesting to now hear you out of what's making prices stay the way they are in this market.
Exactly. So what are we feeling before we get into that part out there, right? We're beginning to see a little bit of uncertainty from consumers, right? There was a lot of momentum. I think everybody's coming to realize that prices are not coming down. This conversation for the last 3-4 years, everybody was waiting for that gap. Rates have come down. They already have come down. The Fed has done a decent job in obviously lowering that rate. I think there's compression that will happen naturally within that market to reposition us. But I think this is where a good real estate agent has to understand this. There's a very big difference between perfect advice versus expert advice, right? Nobody has the perfect advice. It is impossible to do it. But we can provide expert advice. And this is the type of data that positions you to really have that conversation with your clients and guide them through what is going on right now. So the next slide we'll jump into is income, which all correlates to obviously the price that we have. So we've been seeing substantial increases in income since 2014 till now. If you look at the chart, this goes all the way back to 1984. And again, since 2014 till now, we've seen massive growth in incomes more than ever before. So now that prices have been plateaued in real estate and income's coming up, income's beginning to catch up, right? As rates come down, the cost of the affordability of the home comes down, and now we start getting this meeting point, if you will, in terms of the data, right? Florida income as well is projected to continue to increase. Right now we are within the top 25 markets of highest paid in the United States, and we're moving on up. Last year when I presented this, we were at 72, now we're at 78. If you look at Nebraska coming within the 15th best income states, household incomes, they're at 88,000. We're about 10% deviating of income that will catch us up to be.
And I think something interesting here that I will be focusing on a little bit later, but I think it's mentioned, is the one thing is not necessarily what's pushing up the income is that the jobs are paying more, but that we're acquiring a lot more people with higher income. So there's a combination of things that is going to push this much more aggressively than in any other scenario.
And adding on to what you're saying, you know, there's people that are moving here from New York, California, Chicago, but they still get paid in those states, but they're living here.
Yeah.
Right? So that income is not being counted. So if you account that adjusted income, I'm sure we would be within the top 10 for sure, because you see it in how people spend money here, how, you know, they're living the lifestyle here that they're living. It's obviously of somebody with a lot more income than in the median. That's there. So I think that's important, no? So incomes are raising faster than home prices. Why is that? Because home prices have plateaued for the last couple of years on this side, no? So let's get into pricing. This is a very interesting graph where we see sold above list price, right? On the orange side, we see sold at list price and then sold below list price, right? If we look at 2021, obviously people were getting more than what they were asking for their properties. That went on till 2022, and now you're seeing the invert come back, right? People will generally buy for less than list price. Sellers have to be ready and willing to negotiate because the market's a bit softer than it normally, or than what it was back in there. But in the overall picture, it's back to what it was in 2014, 2015, 2016, right? This is more normal behavior of the market.
And the gap has to continue to be adjusted because there's been a gap for a while already with mortgages, with sellers having such low mortgages, and it's been like the frozen market that's there that they don't want to adjust. They don't have the necessity to adjust. It's not a forced sale. They have equity in their homes, and what's going on now is that you're starting to see that at some point people need to make a move and are realizing, okay, this is the new normal. I'm no longer going to sell what I thought I was going to be selling in 2021. So some of these are creating a little bit more transactional flow. So that the fact that transactions are so low has a lot to do also with the fact that sellers have not been in a position of a necessity and urgency to sell, right?
What I think is very interesting about this graph for all the real estate agents who are listening to us is that, you know, real estate agents work really hard to try and help their sellers price properties right. And I think it's a normal human factor where everybody thinks that their home is worth more than maybe what the market evaluates. What you can see here is that it's a historic trend that there is some overpricing. And the difference becomes, if you overprice because you're gonna test the market, how much longer will now your property last on the market, and what is the impact of that on the market? So for real estate agents looking at this is a very powerful slide to the effect for the listing presentation of, you know, what is the impact of not pricing correctly, right?
And in our transactions, we've seen it all the time now where listings that have been sitting in the market for 2 years, and suddenly right now you get 4 or 5 offers for that same listing, even in condos, that suddenly are just adjusting to the right price, and owners are finally saying, okay, you know what, now I'm selling.
Yeah. That's a very important factor. So yeah, I totally agree with this slide, that this is a great slide to have for your listing presentation. So it shows what's going on out there with the seller side. Now, we look at the median sales price for the United States, and we'll notice that we've plateaued, right? We might be seeing that plateau continue with a slightly decline is what we're seeing in our end. Nothing major. I just think, again, as things adjust, you know, rental prices are very low, which we'll talk about that now, which will affect a little bit what the pricing is at, but it's not a big deal, the price movement that we're seeing. It's just up and down, but normally plateauing with a slight decline is what we're seeing. In Florida, we're seeing the same thing. Just very slight decline in price, and it's basically plateaued. If you ask me, overall, when we look at you know, 2-3 years of data, you'll see more of a plateau line than anything else, because it changes every month, right, depending on the amount of sales. Now, let's get into rents. This is another factor that drives price that I was just talking about, right? If we start looking at rents, we start off with multifamily construction. We have to realize that in the United States, we build too many multifamily properties. And those are all being delivered now, affecting many markets and metro areas across the United States. But at the same token, construction has slowed down tremendously, right? If you start looking at this graph, you'll see very strong spikes downwards. People stopped building, starters stopped or slowed down, and permits have slowed down overall. So at some point, we're going to feel this effect of lack of inventory in the rental side. And it's going to swing the market, the rental market back up, because the rental market has been plateauing for many years.
So if you go back for 1 second, what I want to be clear here is, if we look more or less to around 2020, in all of these, we basically see a spike in the number of units completed as well as the number of units started, which were started to be delivered 2022, 2023, 2024, 2025. The permits always are a leading indicator, right? So the permits between 2022 and 2025 get spike, and so now those permits that slow down, there's just going to be not that much more inventory, new inventory coming live on the market. So the inventory that was put out is basically being completely absorbed by these increases in
It all has to do with demand. If you would tell me you would be in a place where there's no demand, you got to stop building. But it's not a demand-driven stop. The reason why it's stopping is because projects don't pencil in with the capital environment and with the cost to build and the uncertainty and on the capital risk and financing that's going on. So it's not a demand problem, it's just a builder's problem, and it's going to, as Enrique and you were mentioning, it's going to delay the issue. So right now you have a little bit of an oversupply or more supply that's leveling off rents because people also are not in an urgency to buy. That's the other scenario, because if not, they would choose to buy. But very soon that demand is going, that the builders are going to start being able to start again, and that's going to become an issue.
So connect the dots for me between the price of rentals given this more supply and its potential impact on the housing market for
so
purchase.
I've always said this, rent ultimately is a driver of price. Why? Because it's the second option to the consumer. So if it's cheaper for them to rent than it is to own, then they're going to rent. If it's cheaper to own than it is to rent, then obviously naturally they'll buy, right? So that has to have an equilibrium, and obviously you consider the expense of living or owning a home, not the total payment of owning the home. Right? Because every month, if you're building equity or you're saving money, that's not fair to say that that's the real cost of living, right? The real cost is going to be your insurance and interest and your taxes of your property when you consider that equation. So all of these factors on the multifamily affect, Now, the interesting part about this is that overall, if there is too much construction, which might have happened now and we'll see clear up, a lot of this can become condo conversions, which can feed the sale of the markets because we haven't been building. So there's an interesting, scenario forming, if you will, with these multifamilies potentially becoming condo conversions in the near future, depending on how they perform. And if, like Andres said, if this becomes Rent America, they won't. But if the home buying ability comes back, you will see more condo conversions. So here you'll see the prices of rent going down in the United States. Again, a bit of the effect of the overconstruction, but now that we stopped, I think it's going to swing back. But for the next year, our prediction is we're going to see a plateau. We're not going to see prices continue to go down. We're going to actually see them plateau on that end. Same thing in Florida, but now interesting enough, where I think Andres was touching upon, is that in Florida, the price hasn't declined so much. Certain markets and pockets have definitely declined. We've seen that, but the overall picture of the median rental price in Florida is actually plateaued. We believe it's going to continue to stay there overall. You will see effects in markets like, maybe Doral, Hialeah, where there was some over construction in terms of the rental price. We've seen it in Brickell, but other markets, you're seeing rental prices actually increase for single family homes, things of that nature. So that's what we're seeing.
When construction stops, within 3-4 years or 2-3 years, you're going to see prices of rents go up in many of the scenarios because the demand is still there. If it's not even going down now, imagine when those units are not coming back into the market. No.
Which is where I think the price will swing, because traditionally rental prices never come down or never plateau like this.
Look at the graph.
This is not normal, right? So I do feel like that will have to adjust itself. So here's a famous graph that we utilize every year. We can continue to feed into it, and it's looking at all the prices of home ownership versus rental. This is what I was talking to you about, Ricky. And if you look at the end of this graph, you're starting to see that ownership pricing is coming down, which is what we saw on the rate effect. Some of the pricing has softened up a bit. So that's also improved the monthly payment. And so we are seeing this tendency where it's coming down, and we predict it's going to come down a little bit more. Some slight adjustment on pricing of properties, and then obviously the interest rates adjusting to more normality. And we are actually very close to what a normal market will look like. So this is that intro where I would say in the next year and a half, we will see that normality come in, where it's going to be a little bit more to own than it is to rent. But that increase or that additional amount you're going to pay is going towards the equity of your property.
Could you tell us what is there a long-term historical average difference between the cost of buying and renting? I mean, I see from the graph that historically buying should be a little bit more expensive than renting. We see that very unusual dip right around 2010 to 2016, 2018.
That's from the crisis,
right,
of the financial crisis. So look, it's very volatile, right? But this drives demand of where consumer goes. Do they rent? Do they own? And this is what creates opportunities for investors. When this flips and goes upside down, where owning is cheaper than renting, that's a huge opportunity for investors to light up.
The reason why that happened at that moment is, as Enrique said, the financial market, because there was no access for financing.
Capital,
So you had to, the only ones that were buying were
cash.
investors that were buying cash, and the prices dropped so heavily.
And they commanded a better return. So
now we hear all the time, particularly from foreign investors, who think that they'll have an opinion on the value of the market, and they think that they're just waiting for the price to continue to drop, that it'll come under the rent. But this is from 1972.
Yeah.
Historically, it's been almost impossible for except for this one major time that was very unique in our financial history. It's almost impossible for the cost to buy to be less than the cost to rent.
The secret here, I think, lies in what I would call a balanced market, is that you're going to pay a bit more to own, like I was stating before, than you will to rent. But the expense of renting and owning need to be the same.
Yeah,
right?
but it's the spread. It's all going to be up, but look how the spread has been so high that now it just makes absolutely no sense.
Yeah, so
the benefit of buying is not that much better, so that I pay so much more. You know what I mean?
Well, what's interesting is if we look to the top right and the green dash lines, which are the projection of where this would continue to go, were interest rates adjusted to 5.5%. The compression, the spread, as you're talking about, becomes very.
And
workable.
had the war not happened, we would be much closer. And the plan this year was most likely to get interest rates to land at that level.
Right.
But given the war, it's just delaying the whole process.
So this is very interesting, and that we're seeing a lot more compression. We're seeing this going the right way. This will align into affordability out in the market, and consumers making wise decisions to start purchasing, right? So let's get over to inventory, see what's going on the inventory side of the equation. So if you look at this, yes, inventory has been going up since 2022 at the lowest point, but ultimately on the average of 2017 to 2020, we're still below. So we don't have enough inventory out there. Although properties are sitting in the market longer, doesn't necessarily mean that there's more inventory than in the past. So this is a great indicator where you see that price is holding up. As long as this equation continues to be the way it is right now, prices will continue to plateau, or you'll see modest shift on behaviors of sellers and the actual properties. So here we look at the active inventory in Florida. This is a great snapshot where you'll see negative prices up in the red when inventory hits that height. And this is obviously something we've seen historical. We see low to no movement in pricing when the inventory is in the yellow lines. And then usually in the greens, you'll see extremely high increases, normal increases, and let's call it high increases. And right now, we're in a market where we're plateauing. You see we're hitting the low to none, we come back to the normal, and that's where we're at right now, right? We might reverse a little bit, come in, but this is where we're seeing that minor volatility, if you will.
So this is a correlation between how much appreciation there is in active inventory in a given market and the number of units of active inventory that there is. So
Correct.
the higher the appreciation, the higher the appreciation, let's say around Q3 2021, the lower the inventory.
Right, and you'll see extremely high pricing, right?
Right.
Prices will go up basically.
Okay.
Okay, so this is very interesting to keep track of the market and see why pricing is behaving the way it is, right? So we're going to dive really quick into inventory and can we add more supply, and we're going to look at loans, foreclosures, home equity, and construction, which I think will give you a clear picture of the inventory that's out there. So number one, the majority of the loans continue as of Q3, which was the last time we could check in 2025. They continue to be great interest rates, 760 plus interest rates. Full doc loans are the majority of the loans that are happening. And then you'll see the lighter blue, which are lesser scores, and then all the way to the orange, which is minimal, which is 620 below, that are funding the actual mortgage.
So very strong underwriting criteria with very well qualified buyers.
Right. As opposed to in 2008 and all these years where you'll see there a lot more lighter blue, a lot more darker blue, and a lot more orange being financed, right? So it's been a very, very healthy, predictable market for the lending institutions, which is great for the market because this is why we still have lenders out there. They're lending, they're moving money around, but they're being very strict and making sure you qualify. Foreclosures are not an all-time low, but pretty close to an all-time low in terms of this graph, and this graph goes all the way back to 2006. As you guys can see here, we don't see heavy movements. We see maybe a little bit more FHA on one side, less conventional. You're starting to see normal behaviors, if you will, within the market. And
People have equity in their homes. So here, this slide
exactly.
with the next one, they correlate. You can't foreclose. You just sell your property, and that's it. The money's there.
So this one's very interesting. So again, last year we were talking about that. There's $34 trillion in equities in homes in the United States. Nobody's gonna just give that up.
Yeah.
To put that in perspective, when COVID hit us, the world, the entire world, including the United States, Europe, China, India, South America, they printed roughly $11 trillion in money into the economy. Well, the United States housing market right now could easily tap into $10 trillion. This is one country just pumping in $10 trillion.
That would be a third of the equity.
And it's a big issue, right? Because if the government lowers the rates too much, or the Fed, you can have too much money come into the market. But there's liquidity. There's still gunpowder in the sideline, which is very, very interesting to see. And we have to let this obviously play out. Interest rates come down. We want to see the refinance boom come into place, but under control, right? We don't want to overdo it. But people will tap into this money, and you'll see this money come back into the economy, right? Whether it's buying cars, whether it's paying off credit card debts, whether it's buying more investment properties. So it's a very interesting time because you're seeing this, and I think this is another factor of why we see such a resilient market where pricing has plateaued. It could soften up a little bit here and there, but we're just trekking in that plateau.
And when you're talking interest rates, it's important to compare what the interest rate is for homes versus the interest rate that you have for all the other assets. Right. Your cars, your student loans, your credit cards, and everything else that you have, especially credit cards. The market has a ton of credit card debt out there. We all know it. And this, even at the rates that you have right now, it's much cheaper money than to pay off a lot of the other issues that households have. So this, you got to keep an eye on this, on when that money starts coming back into the economy.
To put to light to what you're saying, there's, I think, the highest amount of credit card debt in the United States, and I believe the last time I saw it was 1.8 or $2 trillion, something around that. But there's $34 trillion.
That's what I'm saying.
Everybody will refinance and move the money, around, right? So what are we seeing in terms of actual construction? Okay, we continue to see, construction slow down, right? Just like Andres was saying, a lot of these deals are not penciling in, they're not working out. So developers are slowing down, not in downtown Miami, not in certain other areas, but in the United States in general. And we still have that deficit that after the last financial crisis till 2020, we were underbuilding, right? And there's an estimate that there's a shortage. I estimate about 2.5 million homes This is now being reported by the White House. It's being reported by the HUD agencies. They're starting to come out and they are confirming that there is a lack of housing in the United States, causing the price of housings to stay at the level that they're there. How will this be solved? I'm sure there's going to be incentives from the government, things and programs, obviously, to re-incentivize the construction of the industry. Now, in Florida, this is a chart that I've been using for many, many years. I call it the rhythm of the market. It's like a heartbeat. If you look at the chart, right? It goes up, it comes down, and I've measured every pulse that it goes up and every pulse that it coming down, right? Now, this last segment between Q3 and Q1, we see the compression was the second least since 2013, which is amazing. We only had that compression come down to about 15,000 properties.
So in the last heartbeat, from the peak to the trough, there was smaller compression than there normally is.
If you look at prior, you'll see 28,000, 30,000, and then you go back into the 2016s and 17s, you see usually that peak to trough is usually 26,000 properties that sell less throughout that time. So we're beginning to see that, and we're beginning to see weird behavior that you normally weren't seeing, because if you look back at 2016, you'll see peak to trough are points, right? They hit down and then they come back up, they swing up. Now, if you look between 2023 and 2026, you'll see that there's a flat line. It's not peaking the same way, right? It takes a little bit of time for the market to adapt, and spring buying starts, and then you're getting that movement. But this is a good sign that we're beginning to see that it's going up and up, because we had dropped tremendously. So this is a good indicator of pulse that the market is responding and it's coming back up. Obviously, interest rates are there. The fear of pricing going down, I think, has been eliminated or dealt with at this point in time, and the market has proved itself. So these are good indicators, right, that we begin to see. And the average decrease, as you see in the chart, has been 25,481 properties. This time around, it was 15,000. So we're seeing some good indicators on that side, right? So equity in the current home market for sale, this is a very important thing. The average person selling their property in Dade County, which is a good indicator for the rest of Florida, has owned their home for 5 years, has on average $280,000 in equity. Does that person really need to sell? Probably not, right? They can hold off. And that's why we've seen at certain points of the market, exodus of properties just being taken off the markets, right? Because there was no need to sell. So, and if you break it down by price point, like you see here, you start seeing, obviously, there's a lot more equity. The market's between 1.5 and 2 million. We're seeing almost $1 million worth of equity, 5-year ownership on average on properties on that side of it. So again, seller markets are held up very well. They have a lot of equity. Nobody wants to lose money. So we're coming to terms where maybe they drop a little bit, they adjust, they meet the buyer, and we're starting to see those transactions take place. Now, this is a very interesting chart that I put up here. This has every closed sales in Broward, Miami-Dade County, and Palm Beach broken down into 3 major segments: 0 to 500,000, 500 to 1 million, 1 million to 2 million. Sorry, there's 4 segments here, and then 2 million plus, right? If you look at 2021, Broward County had 312 properties that sold over 2 million plus. If we look down to the right, at 2025, there was 718 properties sold in Broward for 2 million plus.
More than double.
More than doubled. These markets are seeing exceptional growth across the board in everything that you're beginning to see there. Now, what's been kind of interesting is they've more than doubled, but it's only 300 sales that happen in the market, right? It's not feeding the mass market, but it is growing. The demands and the percent in terms of percentages are astonishing to see there.
And that's why it's so important in real estate to look at the micro and hyper local markets, because if that's the market you're in or where you're trying to find a home,
that is correct,
and that's where your price point is, that's your reality. And the same for the rest of the markets, and that's why we see so many differences in Florida in so many segments.
And I put in red on 2026 because you will continuously see the markets from $0 to $500,000 start disappearing. Ricky, they're gone.
Don't exist.
They don't exist anymore. Those types of properties are not around anymore. That's obviously way above the average. which is obviously concerning for the middle class and the lower middle class, because you're pricing them out with obviously luxury, properties and movements. So again, these are interesting to see. The natural effect for a real estate agent is to understand these markets don't exist anymore. I have to change my approach, change my segmentation to a better, more affluent market, because that is what's obviously that's moving here in the Miami area.
So what can we expect moving forward?
So here we go. That's the next slide, exactly. What can we expect? I'm going to stick to the conversion effect that we've talked about last year. What are we seeing? We're seeing interest rates coming down. Obviously, we saw temporary volatility, but overall in the next year, I think rates will come down. I think prices stay the same, as you see here. Rents stay the same, but incomes will continue to push their way up as all the effect of this inflation, we have to catch up to it, right? So I think they will start coming up, and we're going to hit the right spot for affordability. Question is, how long does it take to get there, right? That's the million-dollar question, but I think that's the road ahead of how we'll get there. It could be a year, it could be a year and a half, it could be 2 years.
Yeah.
But once we look back in the rearview mirror, I think these are going to be the main points you're going to see that bring back affordability too.
I think this is a brilliant data, and the fact that we've been carrying it for so long allows us to continue deeply understanding the market, and to Andres' point, and he'll talk a little bit more about this in a second, in terms of the update on the Florida effect and all that. This is the kind of information that real estate agents, mortgage brokers, title professionals, we all need to really understand in the market, because the narrative in the broader news cycle, sometimes you lose yourself in all these big numbers without really digging down and understand what's happening here. So thank you, Enrique, for that. And before we move on to the next part of our presentation, I did want to talk a little bit about our amazing sponsors who have been so generous in helping us put all this together. Starting with the Standard Residences in Brickell, Miami. This is a beautiful project. I really recommend all of you to check it out. They have a spectacular website. And for the real estate agents in Miami-Dade and Broward, please, I invite all of you on behalf of Natalie Fernandez to sign up for a very exclusive event on May 28th at the Standard Residences here in Miami. Please scan that QR code, and we'll put a link as well in the chat so you guys can join Natalie on that beautiful tour.
Oh, can you go back for a second? I'll also add here, so the Standard is a branded building, obviously, from the Standard, and they've done an incredible job in picking out all the details, everything that's going on, and these branded projects typically are the ones that get to the finish line. Yeah. You see the highest returns usually on these investments. This is because they have high demands, and obviously the Standard, to keep their brand elevated, they're going to make sure that they do a good job, right? So this is a very unique branded project in Miami, and it's located in Brickell, like you said, which is fantastic.
We also have our longtime partnership with Juan Ibarra, a home inspector with Pillar to Post, who allows you to make your move with confidence. We've seen many of Juan's inspection reports that help real estate agents get their buyers to financing in the finish line. Christopher Sierra, who has been providing expert accounting services for decades, an extremely reliable CPA that can provide solution for both businesses and individuals, with a particular emphasis on real estate investors and international investors, right? A multilingual staff and many years of expertise on issues such as FERPTA, such as 1031 exchanges, such as GPLP structures and offshore accounting. So a phenomenal resource there. Marketingverse, which is a boutique marketing agency for real estate brokers and real estate agents. For the brokers, a very CRM-driven, strategy-driven services agency. For individual agents, a real tailored social media branding and differentiation. So if you guys are feeling like you really want to differentiate yourself and find that edge, Marketingverse is a phenomenal resource for you. Avanti Financial, which is making property financing easy. It's been very impressive to see the evolution of Avanti Financial and how they have been consistently beating the market in terms of pricing and trying to teach real estate agents and their consumers that the interest rate, which is what most people focus on, is not the only thing that'll influence the total cost. And we've been seeing huge savings from clients here. Avanti Capital, a premier asset management firm powered by proprietary technology, bringing together investors and syndications and projects that are returning way above average returns to its investors and bringing projects to the finish line on time and on budget. Propfolio, upgrading property management, helping investors maximize their investment properties through incredibly efficient property management services. They pre-negotiate pricing with their vendors to allow a much more predictable outcome, real-time cash flows, and balance sheets to help investors make real-time decisions. And of course, Folio Title, the Title Sherpa, helping real estate agents, mortgage brokers, buyers and sellers from pre-contract to post-closing. These are the sponsors that really allow something like this to happen. Not sure if you have anything about the sponsors that we've been working with for a while.
Just thanking them wholeheartedly on behalf of the entire Avanti Way family. It's a pleasure to always be able to work with you, service clients together, work with agents as part of this ecosystem. At the end of the day, it's teamwork, it's collaboration, and to us, it's always an honor to be able to be positioned in the same table as you guys, and we really value your support and enthusiasm and everything that we do. So we really encourage everybody that's out there to check them out. And we pride ourselves to try to bring on the right people and the right professionals in every side of the ecosystem to be able to service clients and consumers that we all collaborate with all the time and upgrade the entire real estate experience, which is our vision and our passion.
Absolutely. And to do a successful real estate transaction, it really takes an ecosystem. And Andres and Enrique and the whole staff at Avanti have been working extremely hard on this. And this is part of what we want to speak about in terms of where we are in Florida and how we continue to do successful transactions. Andres, your keynote for many years has been about the Florida effect. For the last 6 years, we've been talking about Florida coming together. What could we expect? What was all the activity that would eventually result in the Florida we wanted to see? And now you have an update for us on that Florida effect and where we are.
Wonderful, wonderful. It's really a pleasure to give an update on this. We've been talking about this why Florida for a long time, and it's something that continuously evolves. So we have the thesis, that the thesis in itself continues to upgrade and evolve all the time. No? So if to understand Florida, I think we got to go back a little bit as well. And the real estate market, did not reverse its course. No, it advanced to pretty much clear progression. So what appears today, as maybe fragmentation or inconsistencies in the market, it's not a breakdown at all in any sense of the word of what Enrique was showing in terms of the graphs and everything, and the transaction slowdown. But it's a natural evolution that's pretty much transforming the broad base that we've had, and it's taking into constant, just broad growth everywhere post-COVID to more of a structured, selective type of ecosystem within Florida. No? So to understand the past, the present, we really have to go and see how this has evolved. No? So I'm going to take you back through 2024, what we were talking about that 25, then 25, and then 26. So what we were seeing in 2024 when I gave this thesis was pretty much a synchronized expansion. Record migration everywhere. You had strong demand and constrained supply, so everything was pushing prices upward, and the characteristic was the phase was pretty much alignment. No, and every metric was moving forward. No, when we were looking at it, passing 21, 22, things were kind of starting to shape up. And it's important to understand that at that point, a lot of things in 23, 24 that you would throw out there, everything would stick and worked. And it's important to see the precedent because now it's a lot of the opposite that it's happening. 2025, we started seeing first signs of divergence, appearing. Transaction volume, as Enrique was saying, also started slowing down. Inventory, I think, was one of the biggest things that we started seeing now rebuilding, and everybody started to now pitch in with inventory. Performance started varying a lot. So this is where we started seeing signals that started to show up, and people said, okay, we were ignoring some of these things that are happening. What is this going to play out in the future? No, so the market was telling us at that point that it wouldn't stay, uniform, and that we needed to take a look at what was going to happen next. And now that we're in 2026, this is very interesting. The market is really entered a structural phase, right? So outcomes, are no longer driven by overall demand as a whole, but the interaction of these three things that I put together here, which is the triangle of the system that we have today, which is the capital, geography, and the product. And the performance right now depends on the market, on more positioning within this system and this triangle than simply just timing the market, right? So there's properties these days that one property next to the other can behave completely differently, and we're going to see how that's the case as well. And that wasn't the case years ago, right? So the market didn't reverse, and I say this because you see that in many outlets, in news outlets. Sometimes this report kind of brings things down to realities that we see with the data, no? So it really appears somehow, and from the graphs that Enrique is also talking about, as a slowdown, but what's happening is that we're seeing and witnessing a transformation. We're going and we're shifting from demand-driven growth, and we're now coming into a capital-driven, selectivity within the market. That's pretty much what we're doing. A lot of people call it a slowdown, but if we look deeper, it's really a reorganization of the market. So that's why the Florida effect that then evolved to the evolution of Florida this year, I think the term that I want to coin for Florida is the Florida reset, right? And it's from a growth story, no matter what, to a controlled market. So it's transitioned from that, and the forces that once drove, pure expansion here are now being redefined and are creating a more disciplined and segmented, environment. So let's go through the three elements, right, that we're talking about. First, let's go through the capital structure, no? And to understand capital structure today, I think the biggest thing that we should look into Florida is migration. Migration has shifted, but it doesn't mean that we stopped growing. If you look at the data, we're still number 2 in the entire nation on top inbound migration. You see Texas is number 1, then you see the Carolinas, etc. The top outbound states you can already see there, California, it keeps on being there, New York, New Jersey, Illinois, and Chicago, and all those places. But the short now is more moderated. Florida now functions as a not all come in state, but it's the churn state, because people come in, people come out. We still have a solid net migration, but there's a lot of outflows as well. But the key here is that the volume. Right now, we got to shift from volume coming in to the composition of what coming in. And if we see this graph speaks 1,000 words, which is, you see how this shows in orange the full net migration, so inflows minus outflows. And we used to be 2022 in the 400,000s, and now we're in the 220,000s, right? But if you look at the bluish line, that is the domestic net migration. That has taken a huge dip, 90% reduction in domestic migration, because a lot of people domestically cannot afford Florida anymore. That's right. And they had to leave. So this is, I think, one of the biggest parts of the story shift since 2024-25 to now, and that's what we should be looking into right now. So the surge is over, but who's coming in? And that's the bigger story now.
And I think this correlates with the graph of income, right? Because you're kind of trading maybe a lower income person that leaves the state because can no longer afford to be here for a more affluent person to the state,
100%.
Right? Which is where I say that income in Florida should continue to rise, and it's there, and I think it shows in the evidence of your slide there.
That's it. That's exactly where we're at. So if you look at this graph, you definitely see that you have the blue line is the people that came into the state, and then the orange line is the people that left the state. The income, not the number, is the income that they had coming into the state and the income that they had leaving to the state. For some reason, you're not seeing the graph on the top, but the graph on the top had 3 years of how the average income of the people coming in net migration went up, and it started like in 120 and went all the way up to like 170,000 of people coming in. And remember, your graph was saying that you were averaging 78,000, but people coming in were over 100. They're six figures, and they're exponentially coming up. Look at the blue space between the two lines. That is the real gap. Yeah. So pricing held stronger, than expected. Because of that, we're seeing middle income movers getting out, and we're seeing high concentration of high income households coming into the market.
So here there's two supremely important points that are coming out of this graph. One, the average income of the people coming in has grown aggressively. And two, the difference in the number of people that are coming in versus the people that are going out, the difference in income is basically double. The people that are coming in have double the income of the people that are going out. So this is an exponential effect upward. You have more people, you have the people that are coming in have a much higher income, and the people that they're replacing have a much lower income.
Yes, and this graph is only domestic migration. I want to show you now international, because, and remember, if we go back here, that's only taking account the blue side of here.
Yeah.
So now, if you add to that the people that are putting their money here now from outside in the global environment, you're going to see how that continues to really shape this storyline incredibly well, right?
When you say outside, you mean outside of Florida?
No,
or
internationally.
International. Okay.
So international. So what's happening? Demand is no longer based on increasingly concentrated among the high earners. It's also coming in from the global side, from the international market. So in that particular, you see it in the new construction. 50% of the new construction being bought is coming from global buyers, not even U.S. buyer. And this shift reinforces that we're going into this capital type market instead of an income type market. And this is very, very interesting. You see only 24% become the first time buyers, and then 50% of the other ones. So the market is more driven by capital, not income anymore. In this slide, I think it's extremely important to understand that global demand didn't just come back. This came back stronger and more influential than ever. And this is a really interesting point that a lot of people are not seeing in the market, which is that Florida captured with $12 billion in 2025 of foreign purchases. And that's roughly 50% year over year of a change. We were at like 8 million last year. So 1 in every 5 international buyers in the U.S. is coming to Florida. What's more important here is the quality of that demand. The median prices that are up, and 70% of these buyers are playing in cash. So versus the U.S. that has versus the overall buyers in Florida, you have 35% paying cash. When you're talking international, they're almost 70%, almost 75%. That's very, very interesting. So another interesting point here is that this segment is not rate sensitive to all the things that Enrique was talking about in terms of the rates. And the center of gravity this year, the story, has shifted to Latin America. You had a lot of Europeans in the last year coming up the charts on who are the countries that are coming in. You have the same countries there. You have the United Kingdom. You definitely have Canada up in the charts, but Canada is buying at a much lesser rate than before. And the ones that have stepped up the game is Latin American buyers, believe it or not. They're moving the needle. So that's on the capital side. Now, if you go to the next section that we've been discussing from the triangle, is the geographic side. This is very interesting in the storyline of Florida these days, in the Florida reset. And I spoke about this also last year, and I called it the Tale of Two Cities. And we were talking about Miami, west side versus the east side of Miami, the high end and luxury versus not. And I think this has expanded to the rest of Florida, and now it's one state, 2 different systems, So it's structurally divided, It operates in 2 distinct markets. You have South Florida has become a market on its own, capital driven, it's the rest of the rest of the state it remains an affordability, wage driven, income driven state. That's a huge difference between these two markets, no? So, and we have to be able to separate those those two very, very well. Now, inside Florida, we're seeing people from South Florida exiting South Florida and going to secondary cities in the Central and the Gulf. So you're having cities like Ocala, Northport, Kissimmee, Claremont that are really topping the charts if you look at the U-Haul statistics that we follow every year. So Florida's story in this reset is not just gaining population. The story has to go with how it's distributing it into which micro markets, because South Florida just became one of the capitals of the world. And that's very interesting to see, no? So South Florida, and this graph should have placed there that the percentage of migration that comes in South Florida versus the rest of Florida. In South Florida is almost 60% of everything else. Yep. So you're talking just the tri-county here when we're talking South Florida, Palm Beach, Broward, and Miami. And so let's divide a little bit of how these two different worlds in Florida are divided. So South Florida evolved into a globally, a competitive real estate market. Demand here in South Florida, as you guys are seeing, is driven by the international market, the capital flows. It's less sensitive to interest rates, and we see it every day here where we live.
Well, and who it's competing against, right? So Florida has been competing against Dubai and competing against South Florida, Miami, right?
London, Dubai, and the major cities of the world, which we're going to see some of those cities right here, right now. I'll take you there right now. So this is Miami, for example. Who is it competing now? Tokyo, New York, London, Los Angeles, Dubai, Singapore. This is what Miami is attracting now. It's one of those gateway cities of the world, right? And it just became that. And the reset didn't come at a lower point. The reset in Florida, and some of the things in the graphs that you were showing before are so important, because that reset, that plateau is happening at a very high priced market. Right. And that we need to understand,
Yeah, and it's cash driven. I mean, more than 40% of the transactions in Miami are cash basis, right?
100%.
And when you get up to 2 million plus, you're seeing that go up to 65, 70% cash.
Well, to address his point before, 76% of the international buyers are buying in cash. So cash is flowing like crazy in South Florida.
South Florida. So South Florida just became an outlier to the United States and even to Florida itself. And then you have the rest of Florida, where the demand here is primarily driven by local income and financing conditions. So the graphs and the information we were seeing from Enrique, it's important as we look at Florida that we have to take it hyper-local. We have to understand what market we're in, because those were averages that were averaging also the ultra-luxury that's happening here in Florida. That's behaving completely different, to the point that he was saying with those high-end 2 million plus properties in Broward. If you're looking at Florida as a state, but you want to look at only Miami market, you can't even put $2 million plus. Here you have to talk about $10 million plus or $15 million plus, because $2 million is the norm in Miami if you go to the east side of Miami, right? So these are buyers that are, monthly payments matter to these buyers in the rest of Florida, and that's why this creates very different pricing dynamics, right? As we continue with the storyline, that's why you see, look at Miami and how the premium in Miami goes against the rest of Florida. Miami is not priced like Florida. It's priced like a global city that entered a capital's market ecosystem. So 5 to 7 times higher. How crazy is that on the ultra luxury? Luxury condos in general, which are $1,000 to $1,500 a square foot against $500 in a foot in the rest of Florida. This is a systematic change. We're talking about not a temporary premium. This is, supported by capital, because you have other moments in time where prices grow because of speculation, and that, it's not durable. Here, this is a reset of the new normal, and that's pretty impressive. So geographically, we have to look at the market differently. And now, the capital flow, all right, let's try to understand what's going on here. Power is not moving to Florida. Power arrived in Florida and arrived with a bang. And every year I've been showcasing in my Florida Effect side some of the celebrities and some of the big ecosystems that they were going to bring, but they started last time, because we're buying here because taxes are better and because of the whole efficiency for their financial world, etc. It's no longer that. Now they're bringing their full-on ecosystems and companies with them.
Go back there, and I think this is an incredible lineup in terms of, we talk about income. I mean, most of these people have stocks and they're bringing balance sheets here to Florida, right? Massively strong balance sheets that generate billions of dollars a year. Talk about the impact of that income, right?
Yeah.
And the job intake that they're going to take, and they're all very creative. They're all very hardworking entrepreneurs that continue with the ambition that they have, right? So this is a turning point, like you're saying.
It's definitely. It is no longer that they bought their house. It is that they brought their businesses. They started investing in local companies. You know, Tom Brady already announced invested in local, and this is already where they're setting up the fundamentals for a hub for all of them. You know, so this is a very interesting change and shift in what the Miami dynamics are creating.
And three of them are in the top 5 richest or top 10 richest people in the world.
Yeah. Yeah, and the other ones are following.
Yeah.
And then you have the Citadel story, and Ken Griffin is not even in that picture, and many others, and Patel. And now they're bringing, you know, Palantir was the latest one that announced that they're bringing their headquarters here. They're putting them in Aventura, and he bought also a home in Golden Beach, and this is the type of neighbors that we have in town. So we grew up to that reset is not a reset that nobody had, that we don't have eyeballs in the rest of the world, and that's why Miami is becoming a place that now it's supported by a lot of things that now have to support this ecosystem of people coming in, but a lot of others cannot afford it anymore.
I also think it's very important here to point out the quality of the leadership that we have in South Florida. You know, Mayor Suarez played a key role in bringing some of these people here. Stephen Ross, the owner of the Miami Dolphins and the related group, has made investments to bring many of these people here and incentivize them. And the kinds of investments that are happening to support the growth of these companies, we have a very large population of young people here in South Florida. And now you have universities like FIU that has invested billions of dollars in upskilling their students. Vanderbilt is building a huge campus in Palm Beach with the leadership of Stephen Ross. So everything from Palm Beach all the way to Miami is becoming this golden corridor, right, of opportunity.
It's an overnight change, years in the making. Years you look at it, right? Because this started back in 2005, 2006, when, you know, the condo market blew up. Brickell started trying to compete globally, and then there was a crisis, and things changed, and again, we're just competing, and now it's literally an overnight success.
What catapulted everything was COVID, and then people really realized at this level that they had to leave their places, and they tested Miami and the market, and then they realized, oh my God, this is really a market where we can live and where we can grow a business, and they tested the economy, the ecosystem of business created by governors and major officials here that opened up the Florida side to the world and to the rest of the United States for these people to now put ground here. So now it's a power relocation. It's not a population growth. This is a very big difference, right?
COVID causing the globalization, if you will, right? Where we were able to connect and now work with all these tools that existed and all these technologies accelerated to the forefront, where people now shift the way they think of living.
100%.
They don't need to be in New York. They don't need to be in, they want nice weather. They want, you know, and they can enjoy these things. Before COVID, they couldn't. They couldn't do it.
They couldn't. And so with that, we come into the fact that Florida, to your point, has become a global platform, and a platform is a driver of an engine of so many things, and it creates an ecosystem around it. So demand here is not temporary, now is reinforced and is backed up by tourism, by the 150 million or so visitors, by all the transportation upgrades that now need to continue to start coming in, and by events that we always talk, the Art Basel and the boat shows and the music conferences and the F1 and all the sports that we have, and what we've created in an ecosystem here, and all the money that brings into the economy. Last year I was able to outline how much money really comes into the economy because of that. This year I'm shifting that focus because that keeps on happening, but what's the new layer? Now global events are putting their attention here, like the World Cup is now having several games here. Now the G20 summit hosting here, and then capital and corporate investments of north of $100 billion and 100 firms coming in now. If we look at 2022 to 2026, this is a different exposure and infrastructure change, right? And then we go to the last section of the quadrant, which is the product structure, right? And this picture here also, or set of pictures, also, count the story very, very well. This was very recent in the Mandarin Oriental when now they're building the new tower. So for those of you that didn't see this building come down, there's a ton of video out there. You should check it out, right? But the condominium market, and I spoke about this in the last years, has been undergoing really structural change. Aging inventory, as you can see from this specific one, is having rising costs, and new developments are the ones that are redefining the expectations, and they're setting up the future inventory and the new standards for the market, right?
I think if you go back to that picture, I think this highlights, that the change of location in Brickell that's happening there. It's incredible because that building is not too old. That building's maybe 20 years old, 25 years old that it was built. It was a hotel, it was famous here. We all went to it and have probably eaten dinner at the hotel or attended amazing events. And you see groups just willing to buy out a building that's not 100 years old, it's not in bad conditions, to tear it down to build a luxury tower now that's coming out there. And I think this is the clear story where if people are willing to do that, you could see the demand and money coming into your city.
The power of this picture, of these three pictures set together here, is so strong because this is the legacy Miami being transformed into the
new
Miami of the future, which is the global city. And that visibility right now just says it all. And it expands all the way throughout the Miami ecosystem. So, we need to understand that the market right now is become selective. It hasn't been weakened, but the buyers want good product. So if you have in the right segment, if you're in the right product, and you put in the right price, your property moves. Yeah. If you're not, then it won't. And that's very important to see. Now, legacy condos, and that story keeps on evolving, but I think it's very interesting how the story is settled today. 2024 there was a shock, rising HOAs, insurance, assessments, cutting everybody off guard. I think 2025, and as we go into 2026, we're seeing the impact, and pricing in other condos are just adjusting. Financing is becoming more restricted and buyers are much more selective, so it's no longer a cost issue. I think it's a liquidity issue at this point. The shock is over, and we're just seeing these condos reprice themselves. So that's what's driving the separation between the new and the old.
And we're seeing it settle. It wasn't as crazy as we thought. The impact was not as bad as we thought. Obviously, there was a bit of a slowdown, confusion, but I think as the process of the state and local ordinances and laws come into effect, that's going to clean itself out. Yeah. And actually, this is going to create a very vibrant market for South Florida, is because FHA and conventional loans will now begin to approve these buildings that for more than 15 years we have not been able to approve.
There's 1,600 towers nationwide that FHA has flagged right now for all the structural changes that are coming.
Here.
And the majorities are here. So you imagine, but that all has to start cleaning up, and then people are adjusting to that. So there's a supply shift. So when you look at numbers and you see the graphs that Enrique was showcasing, it's interesting to get both sides, because there you see numbers and you see data and you see micro data, more micro in terms of Florida and Miami. But if you go behind the curtain, you see how, yes, if supply is increasing, but it's unevenly increasing. Where? So new development in, central places in Miami and some localized area, they're creating pressure on supply, and we'll see some of the places there. But there's other areas where it's different, no? So and what is it that's getting built? Most of the inventory, for example, if you go to Miami, is luxury or premium property, no? So let's look at that. Look at Miami, for example, in South Florida. Actually, the pipeline of new buildings, new towers coming in from 2025 to 2030 deliveries, it's 130 plus.
In Southeast Florida.
That's Southeast Florida. Imagine. Future pipeline, 80% is Miami of that share. That's pretty crazy. The fact that you see 30,000 new units coming into the market. How is that going to get absorbed? But that's a different market. It's a completely different market. It doesn't even touch some of the markets that Enrique is talking about, or the averages where people live.
Yep.
These are very different dynamics. Here you see just a table of how they're divided between the different stages. So yes, not all of them are coming at once. This is going to be a 4-year horizon that we're seeing, and the construction is going heavily up in certain very specific markets. But what's key about all these things is that what looks expensive today is going to become the benchmark in the future. The agents and the professionals need to be able to work this inventory, understand these towers, be able to have the right relationship and get to know this inventory, because this is the future. And that future is going to have that premium, and that's what they're going to have on the resale market as well, with the new standards coming into the market. All right, so it's not about excess inventory, it's about how it's absorbed. There's still some questions in some markets that this is going to get absorbed. I think some markets have a hidden reality that inventory goes up 25 months of inventory and sales are coming down 20%, but it depends where. There are some places where you're ahead of the demand and the demand will catch up. It's just going to take a little bit of time, and you're going to have a moment of how disciplined are you to be able to wait and weather the storm. For example, Brickell. And Brickell shows an interesting side of things where there's temporary imbalances in Brickell as far as supply outpacing demand. So certain areas have moved faster than others. The graph here, the orange gives you the supply points and the absorption, and the little lines didn't get covered, but the absorption is the blue one. So you have moments now in 2027, 2028 that are going to be difficult moments for the Brickell market in general, but you have two markets. You even have in the same street 4 different types of towers that are from 4 different eras that behave completely differently. You have the new construction, the one from the last boom, and then you have the one from the 1980s in the same street. Are those all behaving differently? And this is what you're seeing in Brickell, and it tells you a lot of what the entire market in places like Miami are seeing. There's that huge gap between the resale market and the new construction market that's almost it's double to almost triple. Yeah. So that it's a very interesting storyline. Market segmented, so luxury remains very resilient. The middle market is the one that's more constrained, and it's realizing that the costs are high, insurance is higher, and it's resetting, and insurance coming down, but at very high, it's resetting also at a high level. Mortgages are staying where they are, so that sector is definitely diverging. And one person says the market's strong, the other person might say the market's not that strong, and both are right, depending on where you're looking at the market and from which direction. So if I would have to have one slide to kind of sum up the state of Florida and the Florida research, is that this is no longer about timing, it's about positioning. Success depends on whether you're positioned right within those 3 quadrants that I was talking about. And you need to understand the cycle and where you are and position yourself accordingly, guys. So that's this side of things. And I think to end this up, I think we need to bring in to the audience the investor landscape as well. We deal with Avanti Way Capital and Portfolio, and our Avanti Way agents deal with a lot of investors. We deal with a lot of international capital as well. So the capital investment landscape is important to also understand how it's playing in these economics. So capital still active, and you see a lot in the news that capital is out, that there's no capital out there. It's there. It's just more disciplined. It didn't disappear. It became a lot more selective, and pricing. They're pricing risk very differently than they were pricing it before. So limited partners that are coming into the market are allocating in Florida more than in other places as well. But they now see a clear downside protection, and they want execution certainty as well. Where is capital flowing? And it's concentrating in more stable income producing and strong markets, more of the secondary markets, are having larger issues of deployment and are suffering a lot. If you go to the southwest side of Florida, for example, when you see Lehigh Acres and Cape Coral and places like that, where there was too much investment and the demand wasn't there to hold it, it's where you're seeing some of the biggest risks now coming into the market. So depend where you are, you got to cluster the deals right. Where is capital not coming? I think it's important to put that into perspective as well. I think it's not going where the assumptions are wrong. And rent growth, exit pricing, refinancing, if the assumptions there are wrong, capital is going to be pulling back. They're going to be much more disciplined on the projects that come in. So I predict that we're going to see a lot of projects that will move forward as well in this next phase, because they weren't penciled in right, and now they're feeling that part of the process. So I think now we're going to have a more structured filtering process on where capital goes in, and that's going to tie into the story that Enrique is putting on. How long is this going to take? And it has to do with how investors that really build feel comfortable building again. The challenge today is not the demand for the deals and for the ecosystem of construction. Is more how financing is being done. And most deals today are failing not because that demand, but because people want to be there, because they're dying, because of the capital stack. They can't just put the stack together, and they're just not getting finance, right?
Well, I think here is a key point, because a lot of the capital that is coming into the market is capital that may not be from the Florida locations. They may be coming from other markets. So partnering with real experts at a local level is absolutely crucial to ensure that the modeling that is being done with insurance, with rent assumptions, is correct. I mean, you could have these assumptions could make or break a project.
And people are used to rent assumptions of 5% a year growth. If you're just putting that model into your equation and you see Enrique's graph and the reality of the market, and we're seeing out there, because in the title company, in a real estate company, a brokerage side, and that's a good thing that we have both, and we have the capital markets, because we see everything from a vantage point of the foot in the ground, and that reacts much faster than the institutional capital that sees it 6 months later when, oh my God, the rent assumption shouldn't have been 5%. Now it should be negative, or it should be zero, and that makes or breaks a deal.
Yeah.
And you need obviously good operators that can execute. People are looking for certainty of execution and getting it to the finish line, because a lot of these projects nowadays, one hiccup and you're off, right? You're off and getting debt, and the next thing you know, your construction loan is being called and you have to give in your project because you didn't time things correctly. So it's unique out there.
And there are things getting financed. It's just that you have to be realistic with rents. You have to be having strong sponsors. Not everybody can come into the market right now, and you have to be conservative what you do. Rents are no longer growing. They're stabilizing, and you have to account for that in the deal, put on the reserves and everything else. So you can get deals done. It's just, they're going to have more equity, that more partnerships that you're going to need to have. You're going to have to mitigate the approach, and probably more risk is being assumed up front, that, okay, let's see what happens once we start pushing the product forward. So phase development will be important in that regards. And you're going to have to be more creative. Institutions are going to pause, and when there's money, not money on what side, I think that's why you were seeing so much private debt coming into the market, because the liquidity market stopped on the lending side, and then now, not stopped, but became much more robust as far as the underwriting. And the same thing is happening with equity capital as well. So family offices are coming in where the institutions are not. And so you have to be, if you're on the investor side, you got to be very disciplined right now of where you're putting your money in. And I think there's a great opportunity coming in the next 12 to 24 months. I think the next 12 months, if you're disciplined, if you're going to have mispriced assets, you're going to have stalled progress, you are going to have some of these distressed deals, not on the homeowner side, not on the foreclosure side there, but if deals cannot continue with the current operators, that's where new investors can come in and make it work at the right fundamentals and the right pricing. In some markets like South Florida, some markets like the Orlando and Mid-Corridor, and some markets like Tampa that have the right fundamentals of demand and of income and work and jobs, etc., are going to be the hyper-local differentiators, are where investors are going to put money. You're going to see much less of, oh, I think this area outside X, may develop, so let's put money there for 200, homes and townhomes because it's going to be close to this other area. You're going to be focused more on the main market. So capital will return, but now return faster and smarter. And the market, it's not going to stop in terms of investing. It's just going to continue to recalibrate. So expect a much more disciplined environment. So to end, Ricky and Enrique, I would tell you in this cycle, what's going to be rewarded is not who's fastest in the investment side, but it's going to be rewarding who's the most precise operator and that has liquidity, patience, and discipline to execute.
I think this is a beautiful update for everybody who's been following us for many, many years. And we want to give you guys a quick preview as we wrap up here about what we'll see in the report live on October 27th. So let's watch a quick video.
Just really quick for our viewers before we get the video going. My question would be, Ricky, based on everything you saw right now, is it time to buy and invest?
I mean, look, I think there's always opportunity to buy and invest if you do your numbers correctly. And I think that one of the real important roles that real estate agents can play is presenting the right kind of data. Now, on the buyer side, a huge part of the final return is how well could you price and can you buy? And Avanti Way has amazing tools to get down to the micro level. On the seller side, sellers want more than what their property might be worth in the market. It's so important to understand urgency and motivation. So the residential side is benefiting from a lot of positive things that are impacting the demand. We'll see what happens in the market. But on the Florida side, I mean, Florida is a success story within a success story. Even during the uncertainty in many of the broader markets since COVID, Florida continues to win. It's a well-managed state. It has a surplus in its budget. It maintains low taxes. It maintains low crime. It is blessed by God to have this beautiful weather, these beautiful beaches, and it's really a land of opportunity for entrepreneurs to come and work hard and build their companies and raise their families in a great environment. So I think it's a very exciting time, and what we're seeing from our side on the folio title side is a very, very aggressive increase in demand throughout the state. We're starting to get calls from all over the state of Florida, from new brokers, small teams, people who are in New York and in California who are assisting buyers moving to these markets, especially some of those attorney-driven markets. They need a local partner to help guide their clients through that. So we're very optimistic about what we're seeing.
What's to come? What about you, Andres?
Yeah, I think the fundamentals, we're in the right place in the world. The fundamentals are very, very strong all over the place. We just have to make sure that whatever process we're doing, we have the good advice from anybody that really works in this industry and it's positioned right, like agents that are watching this and are getting more and more data to be able to put out there and have the right vision to advise and be there for their customers. Execution matters right now more than ever. Even with all the fundamentals, I think the question, is it a good deal? It's no longer the question. I think it's what can go wrong and am I protected? Am I doing the things right with the right data and process in mind? Because in the mid to long term, as the fundamentals are there, if you have the right discipline, the right patience, this is definitely a market that has already proven more than anything the next, in the post-COVID area, that it's not fluctuating and you don't have volatility in it. It's more than anything, it's resetting every time at a different position. So be very hyper-local, so the answer is not going to be the same for every agent at every market. It has to be the same, it could be the same concept, but you have to then support it by the data of that particular market segment.
In my eyes, I see it as, if you want to buy and hold for less than 3 years, this is not the market, right? If that's really the intention of the investor, the buyer, don't buy. It's not the time. But if you're willing to have a long-term vision, which is what real estate has always been, it's never been a commodity that just we switch in 1 year, 2 years. that type of experience happened. It's a phenomena that comes for short period of times, like it was in 2021, but it's gone. Now it's long-term horizons always prove themselves to be right. Real estate is resilient. It comes back, it adjusts, it moves forward. And I agree with you guys totally. We're in a beautiful location, Florida, with good demand. And if you're looking for that long-term horizon, 5, 7, 10 years, it is a fantastic time to buy and then continue to invest in real estate.
And I think what consumers are expecting from real estate professionals like ourselves is to provide them honest data, right? Honest data so that people can make the right decisions for their businesses, for their families. And so we invite you guys to come and join us in October to learn more about the market, to connect. The Avanti Report has become one of the most important, connection points in the South Florida market. Last year we had investors from around the United States who joined us. We had international economists who gave us some great perspective. We had hundreds of agents, mortgage brokers. We had, all sorts of professionals from the local economy, commercial bankers, attorneys. So it's really become people in the political sector. We had the mayor of Coral Gables, the mayor of Miami. So it's really a phenomenal place to come and join. Why don't we watch a little bit about what we can expect for October in the next. So we're very, very excited to have all of you on October 27th. Seats are limited, so please make sure to sign up for your spot as soon as possible. Bring your friends, and we'll post a link in the live chat now. And don't forget to follow us on our social media channels where we will be announcing the speakers, the agenda, etc. And as a special thank you for joining us today, we want to provide you with the Avanti Way Special Digital Edition magazine, which you can download now by scanning the QR code. Here we'll summarize many of the points that we made today. We'll include some of the graphs. Use the information for your marketing. Always attribution to the authors is welcome so that it shows the level of depth and authority. And I think with that, I want to wrap up by thanking our sponsors once again. Thank Enrique, thank Andres for your commitment to this kind of event that empowers real estate professionals and real estate investors. And I look forward to coming together with you guys again in October and with all our sponsors.
Likewise. Looking forward to seeing you guys there.
Take
Sign
care.
up. It's going to be powerful.
Thank you, everybody.
Thank you.